The interest rate rise, there is a cost associated with that, but the main reason that interest rates are rising is that the economy is doing well, and so, jobs are more plentiful. We're adding, I think in the last 12 months we had, 250,000 jobs every month to the US economy. I mean, that's essentially adding an Augusta to the US economy every month. Unemployment's down, there's some evidence that pay is starting to increase. And so really the interest rate rise is an indicator of confidence in the economy, that the Fed has confidence in the economy, and that the things that we're seeing are that the economy is on sound footing, it's improving, and we've moved a long way from the Great Recession of 6 years ago. The economy does go through cycles. We have periods of expansion, we have periods of contraction. We will have another recession, we will have another contraction, but it's not necessarily precipitated by increases in interest rates. It's normally precipitated by some shock of some sort to the economy as a whole. The last one was the collapse in the housing market, or it could be an oil price shock or something like that. And the Fed is very clear these days, in ways that it hasn't been in the past, about how it's going to manage its interest rate policy and how it's going to manage its balance sheets. And so it's giving a lot of information, and they call it forward guidance, to the markets, so that the interest rate rise in itself will not be a shock, because it will be built into expectations and people will understand what the Fed is trying to do. So I don't think there's any expectation that this particular interest rate increase or necessarily interest rate increases would lead to a recession. A lot of people have mortgages, but a lot of people's mortgages are fixed rate, and so that interest rate has already been set, and so this change in interest rate is not going to affect them. But if you are thinking of buying a house in the next couple of years, you're probably going to start to see those mortgage rates start to increase. Similarly, car loans and things like that, they tend to be fixed rates, so if you already have them, it's not going to affect you a lot. But as you're looking forward, the likelihood is that interest rates across a range of different ways that you could borrow will start to increase. Credit card debt is a variable interest rate, so anybody that's carrying balances on their credit cards, they're going to start to see increases in interest rates a lot sooner. How quickly credit cards will pass this on, that may depend on each individual card. This increase in itself was relatively small. It's probably the smallest increase they could have done, with 0.25%. And so some institutions may wait until the next rise to start to raise their interest rates, rather than passing on this 0.25% straight away. Credit cards and other rates that are variable, you're going to start to see those change more quickly. The Fed has made it clear that they foresee further increases. The size or the magnitude of that and the timing of that is unclear, but definitely there will be further interest rate rises which will affect borrowing costs in the medium term. You've got to look on both sides of the equation, as it were. Yeah, that there are some costs that are going to rise, but you've got an improving economy, which is one of the indicators why interest rates have risen. And so, your job security may be better, your pay may be starting to increase, and so that may compensate you for the increased costs associated with the interest rate.